As promised then, Escorts is a company that we'll be focusing on. We'll bring up the stock for you as well. They came out with strong FY09 results today. A reported eightfold increase in net profit over last year. We of course have the management with us. Mr. Mal, who's the Executive Director and CEO of the Agri-Machinery Group at Escorts, joins us with some more perspective of how the new financial year will shape up for them. Mr. Mal, great to have you on the show. The stock is up 3% as we speak. What's the sense? What's the kind of guidance or outlook you can give investors and shareholders out there about the company, given the splendid performance for FY09, as to how FY10 would shape up purely in terms of revenue as well as profit growth?
Well, you have to see this on the back of the performance for the year which we have just concluded in October, just 2 months ago. As you're aware, our profit went up, our EBITDA went up by about 50 crores, from 150 to 208 crores, and we crossed the 3-digit mark on our PBT, went up from 26 crores to 111 crores, with PAT going up from 12 to 90. This has actually been on the back of sustained effort on the part of the management in respect of enhancing top line, market presence, cost compression, value engineering. Essentially all the levers of performance have been touched in the last 1 year to bring this performance. And while going forward, I would not like to make any statements, but I would say that as much a smile as we've brought so far, we hope to continue to deliver a wider smile in the next quarter, which in a sense we are concluding in the next 3 days.
Sure. Could you throw more perspective on 2 aspects of your business? One, of course, you've launched a new horsepower tractor range. What do you hope to garner in terms of market share or profitability from this new product? And also your strategy to really address the southern and the western markets. You are looking at those markets quite aggressively this year. What do you see in terms of contribution from those regions?
Look, our market share over the previous year has gone up by about 0.4% on a Q-on-Q basis. Going forward, on the back of new products, especially in the western and southern markets, as indeed a product strategy today that cuts across the entire horsepower range, we hope to take up our market share significantly in the year ahead.
When you say significantly higher, is there a target that you're working with internally?
Yes, we are. A strong target, and
I'm trying to get a number out of you, Mr. Mal.
Yes, I understand. It would be our attempt to cover a few percentage points on market share.
All right, surely enough. What about the margin picture and also the demand scenario? Given that we've stepped out of a poor monsoon season, you think that will play up in the coming few quarters, if not for the entire financial year?
Interesting that you brought up that, because this year's performance, and thank you for calling it strong, based on that performance, as you're aware, we've also, after about 6 years, declared a dividend. This shows signal of confidence not only of the management in itself, but in the market, which you just asked. Fact of the matter is, this performance has been delivered in spite of a recession exactly 12 months ago, as well as a drought in June, July this year. I personally believe that the momentum that the farm sector is catching on will continue. We have actually plateaued out in terms of initiatives on irrigation, seeds, fertilizers and so on. And in my personal opinion, there is no doubt that the next green revolution will happen on farm mechanization. Escorts is poised not only in terms of tractors, but also in terms of solutions and equipment to deliver to the farming community. And it's our belief that as we create more value at the hands of the farmer, we will substantially gain ourselves. So in a sense, it's do good and make good. That's the strategy we're looking at.
All right, 2 numbers would really want from you. One, of course, on the margin front, 9.5% is what you've done in terms of operating margins this financial year. Would you maintain that? And secondly, the debt equity ratio, which was a concern for shareholders, has come down significantly. What's the target for FY10 in terms of how much you would want to bring it down further?
I will answer your first question first, which was the EBITDA margins. We started Q1 last year with an EBITDA margin of 6%. We grew it to close on to 13% in the last quarter, which gave us an increase of almost 2.1% over the entire year. I see a similar momentum continuing in the quarter, which is currently, we're just closing, as I mentioned. This increase in margins will continue. It is backed by two things. One is focus on the market, increasing market share and moderating our prices well, as also cost compression and value engineering inside. So while I would hesitate to give you a sharp number, I see this trend as continuing over the next fiscal.
And on the debt front?
Sorry, on the debt front, yes. I'll just read out a couple of figures to you. We have retired almost 200 crores of debt in the year gone by. And on debt equity, we are a mere 0.12 now, as our press release would have showed you. I think there will be an improvement going forward, but difficult to say at the present stage. I think this is about the right level that we should keep it at. But marginal change, marginal improvement will happen.
All right, Mr. Mal, we're completely running out of time, but there's still a few seconds left for you to give us a quick assessment on what will be the key driver for growth going forward, particularly volume growth, agri-equipment business or construction equipment business. And even though you are saying that you're looking at a higher market share, not specifying a number there, could you give us a sense of the kind of volume growth you're targeting for the financial year coming?
I would think that something to the tune of, we would be targeting close on to 6,000 to 7,000 numbers increase. And as to your other part of the question, which talked about our other businesses, I think growth across Escorts businesses, whether it is in agri-machinery or engineering division or railway engineering division, as indeed construction equipment, I think our growth would be secular across the three lines.
Mr. Mal, really appreciate you joining us this afternoon and giving us more details about the company's performance this time around and how FY10 looks for the company's business prospects going forward. With that, we come to the end of Business Tuesday. That's Escorts for you, picking it up in the session, up about 3.5%. Up ahead on the show, Markets Now carries on with more market action.